Welcome to the Killik Explains finance video. This week, slightly contentiously, I'm going to take on one of investing's oldest cliches. Why buy low, sell high may not actually be great advice for investors. How come? I hear you cry. Well, the problem is this. Buy low and sell high is indeed one of the oldest cliches in investing, and it sounds eminently sensible whether you're buying second-hand cars or shares or anything else. Buy cheap, sell expensive, make a profit. And at first glance, you think, surely that's infallible, that's logical. But the problem is, it ignores our investing brain. Something weird happens to investors sometimes. We are in fact fallible, we are in fact illogical. We can't help it, it's hardwired into us from our days on the savannah, and the impact can actually be quite catastrophic. Now therefore we may have to moderate this buy low, sell high thing slightly. Now hindsight is a terrible thing. What do I mean? Because we don't get the benefit of it. You don't get to see what's going to happen next. Well, let's say you could. So Netflix shares, 10 years ago, you put $10,000 into Netflix shares. Now you might be thinking, well, the obvious thing to do based on this slide would be to have kept them until today, and then you'd be almost a dollar millionaire just on the back of that shareholding. Nice work if you can get it. And for all I know, there are people watching this video who already are. Now, the problem is this. Why is that unlikely to be the situation you're in right now? Well, basically it's because having made a decision to buy Netflix, presumably you had grounds for doing so, you'd done your homework, done your analysis. What would you have done? Now, you could say with hindsight, nothing, but actually what would you have done when 3 months later you'd lost a quarter of your money? How many people would have thought, oh, that was a bad decision, shouldn't be in tech shares, let's get out? And even if you stayed in then, how many people would have seen the $10,000 climb back up to more like $10,300 and then thought, phew, lucky escape, shouldn't have bought Netflix in the first place. 7 months later, I can at least get out at break even, which is a mindset some people have. And they'd have then watched on the sidelines as the stock proceeded to go upwards, thinking all the way it can't go up much further. Well, it has gone up a pretty decent distance since. So, I'm going to come back to the conclusions from that in just a moment, but here's one of them. As Michael Bennett at irrelevantinvestor.com has put it, holding on to a 100-bagger, as Netflix pretty much is basically, is something few people will ever accomplish, even though it sounds like an obviously good thing to want to do. Now what goes wrong? So why not? Well, basically when prices are rising, we don't think perhaps in the most helpful way we could. So when prices are rising, we have a thing called loss aversion. We hate losing money. It's been shown in studies that people are more afraid of losing money than actually making it in many cases. And we look to lock in gains. Some people have a system where they say, once the stock rises 25%, I'm off the table. Or once I get back to break even, I'm off the table. Is that actually a system built on any kind of logic or an understanding or analysis of the stock in front of you? Probably not, but it just sounds a bit safer than sort of do nothing. We fret about buying at the top of the market and overestimate the likelihood of doing so. All right? People are very bad at timing when stocks have bottomed out, but for some reason they think they're better at timing an expensive market. Ooh, things look a bit frothy. Should I sell? What are the chances you get that right? No greater than picking the bottom of the market. As somebody said, no one rings a bell on the way down or the way up. All right? And this is despite the fact that actually, over the long term, if you hang on in there, markets don't punish you too hard for too long, provided you've got the right strategy. More about that in just a moment. When prices are falling, our loss aversion compels us to try and enter the market when stocks are cheap. In other words, people are desperate to time the bottom of the market. That's incredibly difficult to do. And I'll show you how difficult in just a moment with some examples, in case you don't believe me. We underestimate the chances of further decline because we think, I'm the one who's picked the bottom of the market. And actually a further decline can really upset you if you get it wrong, and it's a big one. And that's important. I'll come back to that in a moment. We may retreat when we experience a decline, despite the fact that waiting out a falling market can be stressful and expensive. In a worst case scenario, you might never go back to that market again. And history suggests that's an incredibly expensive way to not play the stock market, if you like. So, a glance at the S&P 500. I could use the FTSE. S&P 500. Yes, we know there was the dot-com boom, which took stocks up and then down again. But actually, 10 years later, we'd recovered most of that. And don't forget, this is capital only, not income. You can be earning dividends in the meantime, of course, rolling them up. And then we got another big dip. But, look where we are today. End of July 2018. Okay, things could change overnight as I'm filming this. But basically, you can see that over the long term, yes, there have been periods where you got punished for holding stocks, but actually over the long term, the market has usually repaid the favour and some on top. And this is, as I stress, capital only, not factoring in the income you can be earning on top. Now, buy low. People think, I must buy low, but actually, when? So here's the NASDAQ, technology-based index in the US. A nervous investor thinking the market's going to crash. At the end of the dot-com boom, 1999, goes to cash. Sure enough, the market then drops 50%, which is pretty brutal, up to January 2001. So you're thinking, great, I've timed the market correctly, now I'm going to buy. It then posted a 67% drop over the next 21 months. Now, this reveals two things. One, timing the bottom of the market is incredibly difficult. And two, people get doubly stressed here. Having gone in there, you might have bailed there, never to go back to tech stocks again. I've taken too much of a beating. And as we know, with the benefit of hindsight, that would be quite a big mistake when you look at what the FANG stocks have done since, for example. But let's say you were never in tech stocks in the first place. So you went for something broader like the S&P 500. No more easy to do this because of this market timing thing. A nervous investor sitting in cash, let's roll forward 10 years ahead of the financial crisis. You think things are going to go wrong in the banking sector, I'm out. By October 2008, the S&P was down 30%. So you think, time to dip a toe back in the market maybe? And then it posted a further drop of 40% in the next 5 months. So here's the stress, here's the point. By trying to be clever about market timing, you might actually make yourself doubly nervous compared to somebody who just decides to ride out some of these big bumps. So, the FTSE 100, just to flip this on its head in terms of the way the market moves, if you like, a nervous investor is thinking, I need to be in cash in early 2016. We've got all sorts of things going on. There's rumblings in China. We've got some referendums coming up in places like the UK. There's a US election on the horizon. Anything could happen. By the end of the year, the FTSE 100 was up 29%. Now what do? Do you carry on sitting on the sidelines and watch it then go up another 8.5% as I make this video? And if you're thinking, well, 8.5 is not as good as 29, no, but it's a darn sight better than you're getting cash and or government IOUs, for example. And that's leaving any income you could earn out of the equation. So, what does all this tell us? Closing thoughts from all these examples, if you like. Number one, stocks are often cheap or expensive for a reason. I know Warren Buffett has said, be fearful when others are greedy when others are fearful, but actually that's easier for him to do than it is for mere mortals quite often. To bet against the crowd, you need a better reason than everybody else. Now, Warren Buffett might have that because of who he is, but do you? It's less stressful, therefore, to often weather a price drop than to try and time it. Because if you try and time it and you get your timing wrong, you double up the psychological blow. And you might triple or quintuple the financial blow when you never get back into the market or completely miss the sharp bounce you often get after a big dip. So I've called it the obvious conclusion. Well, maybe it's obvious to me, but the conclusion has to be, therefore, buy low, sell high. Has to make common sense on paper. It sounds good, sounds logical. But it can actually lead, the stress of trying to do it, particularly regularly, can lead to overthinking, overtrading, and some poor timing choices. So a better bet is buy well. Decide what you're going to buy, what you're going to hold, and then keep hold of it until your original criteria change. Not just because the market's gone down even 25%, but because the fundamental analysis you did at the beginning has in some way either let you down or the conditions have changed in a way that alters it. Yes, then do some kind of more fundamental review. But otherwise, be careful with the buy low, sell high mentality, because as I suggested here, it can actually work against you. Any questions? editor@killik.com. And if you'd like to see some other videos that explore aspects of equity investing in more detail, then it's killik.com/learn, and I'd go for the shares tab.